Okay, in this video we're going to look mainly at the financial account. Before we do that though, I just wanted to point out a few things. When you're looking at the current account, so if you see a graph that looks a little bit like this, basically what it's saying is that this is what the current account is as a percentage of GDP. So the blue line represents the total current account balance, which basically means that we're hovering around a current account deficit between 3 and 6% of our total GDP. You can see with the trade balance, so the orange one is the trade balance, that's representing the difference in the value between exports and imports. So it's just a fancy way of saying what's the difference between the total amount we're exporting and what we're importing. And as you can see, as a nation, we generally import more than we export. However, when the line is above zero, it represents that we're exporting a total value higher than our importing. But as you can see, in most years, the value of imports is higher than exports. The blue line represents the net primary and net secondary income together, so the net income balance. That's always negative because we're paying so much interest on our debt, so it's always got a large negative figure. And together the blue line represents the total balance, and it's always negative because the green line always outweighs, even when the orange is positive, it's still outweighed by the green line and therefore still has a negative balance. To calculate the balance on current account, basically what you need to do is add up the credits and debits in each account. So you've got the 4 different accounts, you've got to add up credits and debits for each one, and then work out what the total current account balance is. So if credits is higher than debits, then that would be a positive figure. If debits is higher than credits, then it would be a negative for that sub-account. As you can see, that sort of just sums up what the different accounts are in any given year, and as you can see that every year we have a current account deficit. Despite the fact that net goods is often positive, the other accounts are always negative. So, financial account, basically the current account means that as a nation we are spending more than we are earning. So as a nation, total expenditure by the government and the private sector is higher than total gross national earnings, and therefore we need to fund that by borrowing money, or we can sell off our assets. So the financial account records how Australia finances its current account. So are we going to do that by selling off loans, which would be a credit in the official or non-official borrowing, or are we going to do that by selling off our assets or our equity, which will also belong into that account as a credit as well in the portfolio or direct investment column. So financial account transactions, we either go into debt and borrow from other countries, or we issue equity and then get other countries to invest in our assets as a way of receiving finance as well. Both of them have their drawbacks, which we'll talk about later on, and both of them are a form of capital inflow. So capital inflow is whenever funds enter the country in the form of either debt or equity, and it refers to overseas parties often being attracted by our high interest rates and therefore being willing to lend us money, but it's associated with debt and equity. It's not associated with the current account at all. It's associated with how we fund the current account in the financial account. The term foreign investment involves capital inflows from one country to another where they basically take some ownership in the company's assets. So foreign investment can include just companies coming over here and the whole company establishing operations in Australia, or it can be foreigners establishing, buying shares in Australian companies, but it's not debt, it's a form of, other form of financing our current account in the form of selling off assets. So you'll hear the word direct investment and portfolio investment. A good way to distinguish between the two is, I've mentioned the 10% rule in the past. So direct investment is when the foreign company has more than a 10% stake in the Australian company, but that also means that they've got some control in what's going on if it's a form of direct investment. So here is a table showing the financial account. So the 4 different things you need to be aware of is what we call official capital inflow. And official capital inflow just means that it's associated with the Australian government borrowing money. So when the Australian government issue bonds or sell bonds, that is official capital inflow, because the Australian government is receiving money from overseas, and therefore it's a credit in the financial account because Australia is receiving money. Official capital outflow is whenever the Australian government lends money. So it has to be the Australian government. So for example, if a private business was to lend, to say, money to the Chinese government, that would still be non-official capital flows because it's not associated with the Australian government. Non-official borrowing is related to Australian residents and banks borrowing money. So credits would be when Australian residents borrow money from overseas residents So that would be new businesses borrowing money, or households buying a house and the bank borrowing money from overseas. And a debit would be Australian residents lending money to overseas residents. Then you've got your direct and portfolio investment. Direct investment involves, again, foreigners purchasing more than 10% of the shares or controlling stake in a business, which gives them some control. So if Japan take over Vegemite, or if a foreign company comes and works in Australia and sets up a business in Australia, that's all direct investment, and that's credit. If Australians were to invest overseas or set up companies overseas, they are all debits in that account. So, for example, if BHP set up a new oil field in Papua New Guinea, that would be a debit because we are giving them money essentially at that point in time. Portfolio investment, less than 10%. So when I buy shares in McDonald's, that would be an example of a debit because I am paying money to them. Even though I will get a dividend in the future, it's a debit at this point in time. Credits would be whenever we sell shares to foreigners in Australian companies. So Qantas sells shares, or BHP or Rio Tinto or Woolworths to foreign investors, they would be examples of credits. Australia always has a surplus in this account because we're basically often borrowing money, the government's borrowing money, but mainly the private sector's borrowing money, and therefore there's a lot of credits in these first two accounts. And the problem with that is it leads in the future to bigger current account deficits because profits and dividends and debt and interest starts to flow back overseas. Thank you.